All right, the volatility continued pretty much during the day today and finished a really volatile week. So now, what do we think? Do we think we are headed towards recession? Do we think that the bottom's about to fall out? I'm going to break down kind of this noise that we're getting and what the noise is expected, what I expect the noise to look like going forward from here, especially over this next week, where we might fall down to if the bottom falls out as things get really, really gloomy. You hear a lot that it's, the best time to buy is when you don't want to. So I'm going to show you where nobody's going to want to, but it might be a good time to be long in today's video. I'm also going to show you where some resistance is going to be before, so you don't get suckered into the rallies as we bounce back up next week. So another volatile week expected. That's the way these things work. We just need to know where the highs and the lows are within our own expectations, so we don't get suckered into either being too much in despair or too encouraged, right? So that's what we're going to break down today's video with a trade idea on how to trade short premium with options in a really volatile time like this. So let's go ahead and get started. Today is Friday, March the 6th, 2020. This is the market outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the market forecast indicator first. You see that we had another day like last Friday where we started down, we gapped down, we went down to a low, and then rallied hard at the close and ended up with a long lower shadow, a little bit of a hammer pattern on both of these Fridays. And we had a down day going into Friday. We had a down period going into this Friday. We had a bounce coming out of it. And again, don't be surprised. A little different than last time, though. We had much more oversold short-term sentiment. We might still come down even Monday before we get our bounce. I've been showing this chart to my classes here at Market Scholars. This 1%, this chart here of the big moves to the downside followed by big moves to the upside. That's what happens. You get big moves to the downside, they're followed by big moves to the upside. It might take a few, but they get followed by big moves to the upside. I mean, 3% gains on the upside. So we had a big move, 3% move to the downside. We're gonna get a big move to the upside here. It might be Monday, it might be Tuesday, but one of these days we're gonna get a big move to the upside to follow that up. And once we stop getting the 2% plus moves to the downside, that's when we're settling in here. When the implied volatility falls below that historical volatility, which, I mean, if you look at that historical volatility now in terms of like how high it is, it's pretty darn high. It's at 0.36, and this kind of give you an idea of was it 0.361528? 0.361528. So that's where we're at right now. The historical volatility, you can see it didn't get that low. It didn't get that high in 2018. It didn't get that high in 2015 when things really hit the fan. You can see it did get that high in 2011. And it didn't get that high in the middle of summer of 2010, even though implied volatility got pretty high. On all of these times, the historical volatility didn't get this high. So again, it kind of shows we're very similar. This is a very similar move. You can see how long it took to work its way out in 2011 with implied volatility as high as it is. And you can see over here, if I were to go back to 2011 and look at all the three, the big moves to the downside, big moves to the upside, big moves to the downside, big moves to the upside, big move to the downside, big move to the upside, down, up, down, up. So it took a few months. You were still getting 2% moves to the downside. Once you stopped getting 2% moves to the downside, you even had a little bit right there. Big moves down, big moves up. Once you stopped getting the 2% moves to the downside, then we started to take off at that point. And it took a couple of expiration cycles before that finally stopped happening. Really, kind of over here is where it started before we had another brief pullback. But over here, it took about a month and a half, 2 months for us to kind of get settled in, and then for the trend to really get going again. And that's when are we going to be really bullish again? Well, when you get dark green shading and a green line. Well, to get a green line, you got to be above a rising moving average, and you can see we're not going to have a rising moving average anytime soon. We're way below that moving average, so it's going to take a while. It's going to be a couple of months before we get dark green shading in the green line to where we can really get going again. As I've showed before, if I come into some of these areas here, you can see once we got the big decline, it took a couple of months before we got the dark green shading in the green line. Once we got the decline here, it took a couple of months, and we were going to get it going, but then we had a trade tweet and the Fed rate hike, and we took off, but then we finally rallied again. Going back to 2015, you can see it took a while before we got the dark green shading green line. Same thing here. Took a month, at least a month, a couple of months. Here's that 2011 period. You can see we got the big move, and it took a while before we got dark green shading in the green line. So it's going to take a while for this moving average to fall down to where we're at. We're not going to spike back up, most likely, but it's going to be some ups and downs, and that's the biggest moves. The biggest up moves occur when we're down below this moving average. We don't get really big up moves once we get it back above it. You get big up moves when you're below it, right? Look at those big moves to the upside. We will have big up moves. So we got to take advantage of the pullbacks like this, because we know big moves to the downside are generally followed by big moves to the upside, especially when we can identify some support levels. And if you look at the Bollinger Bands again, you can see there's very strong support here at 290. Very, very strong support here on a 1-year basis. That's where the point of control is. On the 5-year basis, you can see, there's some pretty strong support below at 280, and that's, if we are going to diverge to the low point, that's where I believe we're going to hit, is this 275 to 280 area, where that big volume node is, right above the value area, the 5-year basis. So there's support here. We might break a little bit down to 280. It's kind of what I expect if we're going to get a divergent low point, a bullish divergence. But it's going to be really hard to get going from there. So when you hit these lows, when nobody else wants to buy, and it's at the, we're down 3%, 4% at the end of the day, we're heading into these strong supports, then just know that they're generally followed by 3% moves to the upside. So we can be able to take advantage of that, and also know that those 3% moves to the upside are generally followed by pretty strong moves back down, like we've seen in the last couple of weeks. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That will notify you when these videos are posted. Hit the thumbs up icon down below the video. That tells us two things. Number one, you liked our video today. Number two, you want us to do it again next week on Monday. So we look at that. That's our survey, essentially. That's our feedback that you can give us. If you like it, let us know. If you don't like it, you don't have to click on anything. Also, while you're down there, comment as to what you got out of it. Why did you like it? What did you get out of it? Let us know. Let everybody else know that comes to our channel, especially for the first time. Join our website at marketscholars.com. There's a link right there in the top right corner of your screen. Click that link. You can go. It takes you to a page where you can subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day, and join our Market Outlook Facebook group that we've created. If you're watching this on our website, we invite you to check out some of the other stuff here. Our classes are coming up here next week. You get access to all of our trading rooms with our monthly subscription. So click on this link here. That can give you some more information on that particular plan. If you click on this pricing, there's our two plans, but if you click on pricing, it compares the two, so you can see what you get with each level. Also with that monthly plan, you get access to our Market Outlook live trade review video. So every trade we do in these videos, we manage the trade. We position size with our class portfolio, and then we manage the trade all the way to the close. So if that's what interests you, and I know that's like one of the most requested things I always get, then you want to check that out. That comes, like I said, with the monthly subscription plan. We also invite you to subscribe or engage with us on social media. Hit this little heart. It opens up this window, and like today's Market Outlook tweet. Hit that thumbs up. It takes you to your Facebook page. You can do the same thing there. Again, the more you engage with us on social media there, the more they will make sure to promote all of our content to your timelines, even when you're not looking at your timelines every day. So when you come back to it, you can catch up on everything that we've put out there, and they'll make sure that you see it. All right, now if you look at the weekly chart, you can see another big weekly candle here, sitting right at the Hakinyashi close is sitting right at the 38% level. Now keep in mind this next week's open, the Hakinyashi candle open is the midpoint of this week's candle. So we're looking at the midpoint of those two between the open and the close. So 3102 is where next week's is going to open. So that's right about there, right about in this area. and then the close right now, the close will be right around 29.72 because that's where the actual open is for the market. So that's way down here. So it's going to be another pretty decent sized candle. But you notice we're not getting lower lows. That's when you have to worry about you get that low point that kind of sets the low, right? You get the lows that kind of sets the low here for a while, and like I said, we had that kind of craziness over there. But if you go back to some of these others, that big candle low set the low point. Same thing over here. The big candle low set the low point for a while. Same thing over there in 2010. The big candle low set the low point. So here we are. The big candle lows kind of set the low point. We might go down a little bit more, but we'll probably trade in that area for the next little bit. Here, right around that 50% retracement of this run that we've been on, for this market sentiment run that we've been on the S&P 500. Now let's take a look at the 3 green arrow charts here, and you can see obviously we have 1 green arrow. We don't have the phantom red arrow yet on the stochastics. If you take a look at the 2-line versions, and I told you before how great that rally was. All it did was get us to the 8-day moving average. It's hard, when you get so far away from the 8-day moving average, it's hard to stay that far away from it. You tend to pull right back up towards it. So like I said, we might pull back down next week, but Monday early, but we're pretty far below it again, and that usually leads to a snap back towards it. Towards that level. So we'll kind of watch and see. And remember, 280, that's where your divergent low point that's where that big strong area of 5-year volume support is. So that's kind of where I expect, if we do pull below these lows, that's kind of where I expect that we'll hit at a 280 level. Ideally, we hit that kind of really early in a day, like Monday or Tuesday, because then it will lead to a long lower shadow and a bullish move. So if we open up Monday, or if we were a little bit bearish Monday, and then we open up Tuesday, and we, at the beginning of the day, make our way down to 280, because it's got to be during the regular trading session to get that long lower shadow, that would be the most ideal scenario. And that's the kind of area where you're going to be looking to scoop some stuff up at some cheap prices. You can see obviously we're in this bearish mode on the intraday chart where the high is on the left of the low. We're not going to get a new high anytime soon, but that high is going to start coming down. Like, give it another couple of weeks, that high is going to start coming down. So we will get a little bit closer to it as we kind of trade in the lower half. When you get this big wide range, you end up trading in the lower half of the range for quite a while before you finally break through. Again, when you look at the chart, the way that you can chart that is with that Arun indicator that I've shown you before. When the positive, so this is the high tag right now, so you can see the high tag, it's working its way all the way towards 0. You notice when it gets over there, it doesn't stay over there for very long. The high tag starts working away really quickly back to. So keep that in mind. Over here you were for a little bit of time. Let's go back to some of these other market sentiment pullbacks here. So you can see the low tag stayed down, or the high tag, excuse me, stayed on the left side of the chart for a while before that move up to the upside. Same thing over here, we got down, but you notice then we got it back up again, then we hit back down again, and then we got it up. So it might come down and spend probably more than just a few days. That's kind of more of an intermediate pullback. These are more of your market sentiment pullbacks, so it might spend a little bit more time. There's the another intermediate pullback. There's one right there too, where they come down, they don't stay down for very long, and they pop right back up, and then they stay up for a while, right? So you can see when they're up there, the high tag will stay up for a while, and then the low tag will stay over on the left for a while when we're really this bullish. So on the intermediate pullback, on the market sentiment pullbacks, the low tag might stay up for a little bit of time. Here's another one. It doesn't stay up for very long though. And you can see it's already starting to drop. Like, we had the low tag, we're already starting to drop. That's how you graph this chart. That's how you graph the high and the low tags, and see where they're at. Because it's bearish when it's over here, the high tag's over here. It's bullish when the high tag's over here. And you can see the point of control on this chart still way up here. So we still got, the value area for the last 4 weeks is still above us. That's a lot of resistance. It's going to be really hard to get going. So I expect that we'll still kind of have, we might, bounce back up here, but we're probably, the path of least resistance right now for the S&P is to the downside, not to the upside. we've got a lot of volume above us now. It's not going to be as easy. Back over here, we didn't. When you were looking at that 4-week range that was over here in 228. So let's see if it will let me do this. 228. And then we'll go the 4 weeks before that. So 1, 2, 3, 4. And we'll go to where are we at on this? A 10-minute. So you can see there wasn't as much volume above us going into that Monday, Tuesday, last Friday. Now there is a lot more volume. See, now you look at that chart and you say, okay, now it's a lot different. Now we do have a lot of volume above us, so that's going to limit our upside to probably about 300. And if we gap up there on Monday, that's probably about as far as we're going to get before we come back down. And like I said, either test 285, if not 285, all the way down to 280. But then there's going to be some really significant support in that area. And ideally, if it does that, if we open up higher around 300 to 305, if we open up here, take advantage of that, because a move back down is more likely, and that would be the ideal scenario, because then that would give you a long lower shadow on the weekly chart if we were to rally back up by the end of the week on that move. Let's take a look at the today's volume in the trading range. You can see 228 million. The trading range was 8.5 points, but you have to include the gap from 302.46 to the high of 298.76, so almost 4 more points that you'd add. So about 12.5 points again. When you put that into this chart, we're going to hit that 3% mark, and last time we did was 2011. And again, we set the low point here, and then we just were grinding around for a while until we started getting the ATR to drop back down. Our range just started getting smaller because again, we're 3%. That's nine point moves. For us to start getting down to back towards 2%, we have to stop getting 2% declines. That's when that we've kind of settled into the point where there's not as much downside left. Now it's just a matter of ups and downs until we get that dark green shading in the green line. Then we will start working our way up to the upside. As I mentioned before, it took a while in 2011. So if I were to zoom in here and go out to 2011, so a very similar period right here is where we're at, right? And let me see if I can't make it a little easier to see. Yeah, it's not the best, but you get the idea. So here's where we were at 3%. By the time we really got going to the upside was back over into this area, and we were back down to 2% by then. And the volumes were back down, the trading rate. So it stayed up here for a while because we had such big moves up and down. Some of these other other significant moves to the downside that weren't as big. This one, 2015, we had a 2% decline. By the time we really got going again, we had fallen back down to closer to 1.5%. Same thing over here in 2016, we got to 2%. By the time we got going again, we were headed back down. So we've got to start heading back down towards 2% before we really get the dark green shading green line again before that happens. So expect big moves down followed by up, and then more down and followed by up, and until we stop getting 2% moves to the downside, which by then the ATR will be falling. That's how we'll know we've kind of settled in at that point. Finally, looking at volatility, the other thing too to keep an eye on is this volatility index. Look at the long upper shadows. We are high. We can trade within. We can get more long upper shadows. We are, still really high on a relative basis, which again means that we're still working things out. It's, you go back again as far as we can. You go back to that 2011 time frame, August of 2011. You can see how we got up and we came down to 30, and we traded up around 40 for quite a while, and we traded up here. We got up to 125%. We stayed above 1 for quite a while. So it wasn't really until you broke down below that 90% level that we got going to the upside. So you can see that's not going to happen anytime soon. But, the more we can trade towards 95%, that's going to be your low points on volatilities that will lead to bounces again. Back, pulling back down towards 2035 will bring this down towards 95. 1 or 95, and then it'll bounce, and that will be our, those will be a big moves to the upside that make that happen, as you saw here. But then it will bounce, and it will bounce back up to 30, 40 in that area, and as we saw, this can happen for a few weeks, if not a couple of months, before we finally break below 90. We settle in, we get going on a new trend. Because remember, moves like this, as I tweeted out, if you follow me on Twitter, I tweeted out, we've seen moves like this in the past, and every time we've had a move like this in the past, the market, the median return 1 year later has been 24%. So we'll settle in and we'll get going again. And the more people think we won't, the more likely we will. Again, nothing's ever 100%, and so it might not happen this time because nothing's ever 100%. But so far, that has been 100% when we've had the type of selling so extreme and so sudden as we've seen in the last couple of weeks. All right, before we start talking about what's driving this market, a really quick technical summary is, we've been bullish. We've had a couple of down moves. It started to go into a rally here at the end of Friday. It won't be the same kind of bounce that we saw on Monday and Tuesday because we have more resistance now above us. So it might be a little bit shorter of a bounce Monday, but then watch for a retest of the lows again, if not further down. And when we break the 280, if we break the 280, things are really going to hit the fan, and we're really going to have market turmoil, and that's actually going to be a really good thing. The more the better, right? Because the more, like I said before, the more people think we won't go back up, the more likely is we will. So we want more turmoil. We want more financial media. We want people saying how crazy and how bad and recession and we want those kinds of things because that means the market is that much more likely now to get going. That we've set the low and get going. I expect that will be the case as we head towards that 280 level in SPY. So what do you think? Do you agree with that technical assessment? Do you disagree? There's a link right there in the top right corner of your screen. Click on that link. It opens up a poll. Hit either agree or disagree. If you click disagree, I'm sure there's people that will. Let us know. Share with us what you're seeing that would suggest otherwise from what we came up with here today with other market scholars in our community in the comment section. All right, when we talk about what's driving this price action, I saw something that was kind of interesting. It talked about how we might be in more of a recession than what people think. I've got a few charts here that I've got set up, and the other thing is like, why is the Fed cutting rates when the market's unemployment's still really low and inflation's really, it's not rampant, it's not really low either. Here's the reason why. If you take a look at what would it be? This chart right here. Is it that chart? It might be. Yeah, I think it's this chart. If I bring this over, this is. No, this wasn't it. This is the chart I wanted to show you. When you look at this chart, this is the chart of 5-year forward inflation expectations. So long-term inflation expectations going forward, not current inflation levels, inflation expectation levels for the long term going forward. It's generally around 2 to 3%. All right, that's the normal. That's the normal range. Sorry, that's what we had to kind of show it. It wasn't show here on the right because I got it as percentage. So you can see all of this, but we're pretty darn low. We're as low as we were back in 2016, when things were really like we had a global slowdown, and things turned around in 16. We headed up higher. But that's how low we are in inflation expectation. As bullish as the stock market has been since that Christmas Eve low point, as bullish as the stock market's been, inflation expectations haven't been. The green line here is crude oil prices, and you can see they haven't taken off since that Christmas Eve low point. And then the purple line since that Christmas Eve low is the 10-year yield, and you can see how it's even lower than we were over here. So now that's probably a little bit, you can see with this chart that might be a little bit overblown, and I think it really is overblown. I think TLT, I tweeted out Friday that TLT might have had a blow off top with extreme amounts of volume and a big move to the upside. Outside of multiple standard deviations on long-term linear regressions, very extremely overbought. Not the type of market that leads you into recessions. In fact, this is the type of market that's actually, usually you get during recessions. I mean, even from the beginning of 2014, you can see another period of time where we just didn't have, like, this is when you started to taper QE3, then you ended QE3 here, then you had the global slowdown that ended there. I mean, that was the market. What didn't really die very much either. We did have the big pullback in August of 15, and then the subsequent death cross in early 16. We had some volatility here, but the market didn't. We weren't in a stealth recession, but you can see how. And the crude oil and yields and inflation expectations really dove from beginning of 2014 on. So when you look at it on this chart here, let's go to SPX on this chart, and you go back to 2015 or 2000, from the beginning of 2014 to the middle of 2016. It was a period of volatility, but it wasn't a decline, right? If you look at, like, other international markets, beginning of 2014 to the middle of 2016, we had a much bigger decline. That's EEM. If you look at EFA, here's the beginning of 2014 to the middle of 2016. You can see a much, much bigger decline. Well, we just basically had the same thing. Just because the S&P 500 isn't down from January of 2018 doesn't mean that we haven't been in a bout of deflation, right? Of falling yields, falling inflation expectations, long-term inflation expectations, falling crude oil prices. So when you wonder why the Fed's doing what they're doing, that's why. That's why the Fed's doing what they're doing. If you look, but that's okay. If you look at the yield curve, here's the yield curve inversion between the 10s and the 2s. You can see we're about to head into a period of green potentially. We're almost inverted and we're starting to head up. This is the long-term 15 200-day moving averages of the yield curve inversion. And usually when we're green, that's not a good thing, right? When it's green, you can see the stock market in purple goes down, the yields go down. Here again, you're green, stock market goes down, the yields go down. And then eventually the stock market and yields rebound as we're at the end of it. Same thing over here too, as we're at the end of it before we go pink. That's usually, a good sign for us. Well, this is a little different, and it's very similar to this 2013 heading into that 2014 period. Here, yields, we had this pink level. Yields came down during that pink level. It wasn't rising yields that made the pink level. It was falling yields. And that's very similar to what we got right now. It's falling yields that has made this pink, not at the beginning, right, when we were raising rates, but since we stopped raising rates and for the rest of this time, it's been significantly falling yields that have produced this yield curve inversion. So it's a much, much different environment. When we're starting a green level with high yields, that's recessionary. High yields, but when we're starting a green turn with low yields, as we saw right here in middle of 2016, that was really bullish, right? At the end of that kind of recessionary beginning of 14 to the middle of 16. Remember, that was the last period that was pretty deflationary. Well, the yield spread really came down too during that time, and that led to a bullish run. Well, we had the same thing here, and that's potentially leading to another bullish run. Another reason why, again, we've kind of been in this stealth recessionary environment since that January 2018 peak. This is the asset classes from that January 26th. Emerging markets are down 20%, developed markets down 17%, small cap stocks in the U.S. down 10%, and down most of this period. Only this brief little rally got it positive, and these two never did. Crude oil has been down 33%. It's been down this whole time. Had a little bit of a jump early. But look at gold's up 23% since that peak in January. Long-term bonds, which have gone parabolic here, are now up 34%. The dollar's up 11%. Real estate prices are up. Foreign bonds are up 7%. I mean, this is not a chart that suggests we're about to head in the recession. This is the type of chart that suggests we probably have been. In fact, the only reason why we don't think we were is because of how these sectors have been doing. If you look at the same chart, same time frame, but with the different sectors, you'll see that real estate, utilities are up 30%, real estate's up 20%. There's your S&P 500. You've got consumer staples and healthcare, other safe haven oriented sectors. You have cyclical sectors down here, materials and energy, way down from that peak. Financials have been down most of the time. Industrials have been down most of the time, 9 to 15%. Like I said, staples and consumer discretionary kind of been there because consumer's been actually holding up halfway decently. And there's a reason why consumers and this is before XLC is not on here because XLC they made that change to the different sectors, and you can see technology was. So the main reason why the S&P has held up so well is because of this chart. This is the weekly chart and the 50-day, 200-day moving averages of these five biggest, trillion-dollar market cap companies practically: Facebook, Apple, Amazon, Microsoft, and Google. And they're up 30. I mean, even with this pullback, before the pullback, they've been up 43% during this run where nothing's been up, right? Where everything has been, where the safety trade's been so bullish, these stocks, even with the pullback, are still up 30% from that January 26th peak. But when we had the big decline, and they had a little bit of a decline, about 8%, and then they fell in Q4 of last year, but then they've rallied so sharply. That's the biggest reason why we don't think we're in a recession or haven't been in one, because those stocks have been doing very, very well. If you look at the sectors on this chart, this is all the weekly charts from that same January 26th time frame for all the different sectors. Here's your S&P 500 is up 8% since that time. XLK is up 33%. XLY is up 8%. XLC, remember, it's got it's had the big change from there. But look at all these others. Look at energy, look at materials, look at industrials, look at financials. These cyclical areas, they don't look like they're in big bullish markets. I mean, this was up 23% at one point. They don't look like they've been in big bullish markets. Your safety trade, as bullish as it was and still is, I mean, that's not indicative of excessive risk taking that would lead to recessions, right? These would have to be the ones that are all up, especially these cyclical areas. These would have to be the ones that should be showing 20-30% returns, and they're just not, and they haven't been. So again, it's kind of been a stealth recession because of this. Because of a small sector. It's not a small sector, it's actually the biggest sector by market cap weighting, but it's a small grouping of stocks that have really kind of led this charge and kept the broad market as a whole afloat, while other risk asset classes have been flat at best, if not down significantly, like commodities over the same time frame. All right, so for our trade idea of the day, and this is the benefit of going to the Market Outlook Live, because we do the Market Outlook Live at, it would be 12:30 my time, so it'd be right, not 12:30, 1:30 my time, so it'd be right here. This is when we do the Market Outlook trade, and you can see we did a bullish trade on Coca-Cola, and look what happened after we got into it because of the late rally in the market. So again, a benefit of the Market Outlook Live for our monthly subscribers, if you can attend it live, at 3:30 Eastern time. We do put the trade on before the market close. Now that might be fleeting, right? We might lose all of that early Monday, so it's not that big of a deal. But you can see why it'd be a benefit for any trade to be able to look at it before the market closes instead of the next day. Coca-Cola has really had a big decline. In fact, if you look at the weekly chart, that's a really nice bullish pattern. Yellow line, light pink shading. We've had a big pullback here. You're at some pretty strong support levels. You're at the 200-day moving average on the long-term chart. We've been trading right at that 200-day moving average. Unlike the S&P, which is where we're pretty much right on it. We were right on it at the end of the day when we made the trade, and of course it bounced up. And the other thing, too, that stands out on Coca-Cola is you've got strong support levels. We are right there on that support. And then if you look at the longer term, you can see that's if you break through this, then we're to the downside. But, a good chance that we can hold this with how far back we've pulled back here. And as with the bandwidth as high as it is, for it to settle down. You also see, too, the Ichimoku cloud will also, on the long-term chart, not only on the daily chart here, but also on the long-term chart, has a good chance of helping you hold up in this area because it can act as a support when you've been on a good trend like this. So there's, now it doesn't mean that it can go down to the bottom as we saw over here. But you've got a lot of good support in this area. And when you do have a lot of good support, I've been asked quite a bit on how to do short premium trades. We do a lot of long verticals and long calls and puts because this is a pretty directional. I like small risks and bigger rewards. But I know a lot of people do short premium trades, and I'm not a big fan in this type of environment because it's got big risks for small rewards. But I showed you how to do that with this trade idea. So we actually sold the at the money because that's where that big strong support was, and we were right on it. We've gone up a little bit since, and that's what this gap represents there since we got into it. And as long as it stays above this support, great. I make 420 bucks. It doesn't matter where it goes. I make 420 bucks. If it breaks the support, again, the most I'm willing to lose, I'm putting 780 bucks at risk, but the most I'm willing to lose is 480. So if it breaks that support, there's a very good chance that I can keep my 420. There's a very good chance I can keep my loss to 420, no matter how bad it gets. And that's kind of what we want, right? I cannot lose 780 bucks. It takes a lot of small winners to make up that big loss. So I need to keep my loss small. So not only can I keep my loss to 420 bucks, which would be the worst case scenario that I would like for it to be. The other nice thing about it is we'll know, like if it breaks down to 53 or 52, then it's breaking that support. And I don't have to wait to lose 420 bucks. I can lose smaller. I can end up losing 200 bucks. So I end up with about a 2-to-1 reward to risk ratio. So that's kind of how you can do a short premium trade, but still keep my risk really small, but have a pretty decent reward for that small risk. I'm putting more on the at risk, but because I've got that big strong support, because I've got a lot of room to work with, because we're at the money and the way the setup is, I can still be able to have, in this case, a 2-to-1 reward to risk ratio if I can keep my if it breaks that strong support and moves down to that spot. So it's a way to do a short premium trade. Again, I sold the 54 put, so anything above 54. I bought the 52.5 for to keep my risk flat here to the downside. But again, I don't want to take 780. I want to take no more than 420. And for me to lose 420, it's got to go way down here. And my big support's right here. So if we get to this area, I know that it's not holding support, and that's going to be my cue just to take an even smaller loss than that and get out of the trade early. All right, well, that wraps us up for today. Again, thank you all very, very much for coming on. You've heard from me. Now I want to hear from you. Use that link right there in the top right corner of your screen. It opens up, it takes you to our Market Outlook forums, one of the things you get for free on our site. And you can be able to interact with our Market Scholars community. And let's keep this conversation going over the weekend into next week. And we see how the market opens up after a crazy, crazy couple of weeks here. So, again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between the videos. Join our site at marketscholars.com as well as our Facebook group to be part of our community. Have a great rest of your weekend, everybody, and we'll see you all on Monday.